All right, today we're going to tackle a perspective that might just change the way you look at the financial markets forever. We're talking about the market maker paradigm and the hidden logic that's really pulling the strings in Forex. So let's just kick things off with a question that I'm sure every single trader has screamed at their screen at some point, probably after a really frustrating loss. Is the Forex market rigged? Does it just feel like the whole game is stacked against you? Well, here's the thing. The truth is a little more complicated than that. It's not so much rigged as it is engineered. See, there's a blueprint, a hidden logic that's driven by the needs of the market's biggest players. And today, we're going to decode it together. Okay, so let's get right into it. To understand this, you first have to see the market for what it is. It's not some neutral playing field, right? It's a strategic environment. You could even call it a predator's game. This slide, man, it just lays it out perfectly. It frames the two sides of this game. On one side, you've got the retail trader. That's the prey. They're reacting to price. They're following all the textbook patterns. But on the other hand, you have the market maker, the predator. And they don't just react, they literally engineer price movements. They create those same patterns as bait, all to absorb liquidity. They're the ones designing the very environment everyone else is trading in. And this quote from the source material, wow, it just cuts right to the chase. It's not personal, it's structural. We're talking about a zero-sum game, and for these huge institutions to win, smaller players often have to lose. It's as simple as that. So who are these so-called market makers anyway, and what's really driving their behavior? Let's pull back the curtain for a second and look at the one core problem they are always trying to solve. The key to all of this, the secret sauce, if you will, is a concept called slippage. Just imagine for a second you're trying to buy, say, $1 billion worth of a currency. If you just slam that huge order into the market all at once, you're going to move the price against yourself, and you'll end up getting a worse and worse price. That's slippage. And for these giant institutions, it is their single biggest operational nightmare. And that's why this whole idea of market manipulation isn't really about some evil guy in a dark room twirling his mustache. It's framed as a necessary evil. It's a calculated, logical solution to their slippage problem. See, these institutions need to find enough opposing orders to fill their massive positions. And if those orders just don't exist, well, they're incentivized to create them. And that leads us directly to their number one tactic for creating that liquidity. It's their signature move, a play so common it has its own name. Let's deconstruct the stop hunt. Okay, first, let's get a nice clean definition on the board. Investopedia calls the stop hunt a strategy that tries to force people out of their trades by pushing the price to a level where a whole bunch of stop-loss orders are sitting. This forced selling or buying creates this giant pool of liquidity that the big institutions can just scoop up. So how does this actually play out? Well, it's a shockingly predictable four-act play. Step 1, the bait. Price just kind of hangs out at a really obvious level, building up retail confidence. Then, step 2, the hunt. They engineer a sharp, aggressive move, usually about 25 to 50 pips or price interest points, right through that level to trigger all those stops. Then comes step 3, the trap. The price whips right back, tricking all the breakout traders. And finally, step 4, the true move. Now that they've secured all that liquidity, the institution finally makes its real move, leaving everyone else in the dust. And the craziest part? The hunting grounds, they're the exact places you've been taught to trade. They weaponize the very tools from the trading textbooks, obvious support and resistance, really clean trend lines, and yeah, even popular Fibonacci levels. For them, these aren't signals, they're bait. They're used to create these predictable pools of money. Now, this isn't just random chaos. Oh no, this manipulation follows a beat, a hidden rhythm, a cadence that's tied to the time of day and even the day of the week. Each of the 3 main trading sessions has its own distinct personality, its own job to do. The Asian session, that's usually quiet, it's consolidation, that's where institutions are accumulating their positions. Then the London session hits, that's prime time. High volume, you see these perfect setups, and yeah, it's the prime time for a stop hunt. And then comes the New York session, which brings the high volatility, often just continuing the trend that London started. And if you zoom out even further, you can see the same story play out over the entire week. Sunday and Monday, you might see a push in one direction just to get retail traders to build up their positions. Then, bam, midweek, Tuesday, Wednesday, or Thursday, the major reversal often happens. By Friday, the price frequently cycles right back to where it started, completing this weekly pattern of manipulation. Okay, so we've seen the game, the players, the playbook, the whole shebang. So what do you do about it? How do you survive? Well, it's going to require a complete transformation of your perspective. You have to go from thinking like the prey to thinking like the predator. The goal here isn't to find some magic indicator. It's to completely flip your thinking on its head. It's about reverse engineering what everyone else is doing. You stop asking, where should I put my stop loss? And you start asking, where is everyone else putting theirs? You have to start thinking like the game designer, trying to figure out where the traps are going to be set. I absolutely love this analogy from the source material. The market maker, that's the leopard, and it's hunting its prey, the retail crowd. Your goal is to be the master hunter. You don't jump into the middle of the chaos. You wait patiently for the market maker to make their move, to execute their stop hunt, and show you their true intention. Only then do you strike, moving with the market's most powerful force. So let's boil this down to the core principles. This is the new mindset. First, you see those common textbook patterns as potential traps, not signals. Second, your job is to identify where the big clusters of stop losses are probably sitting. Third, you wait for the market maker to tip their hand with a stop hunt. And finally, you trade with their true move, not the initial fake out. And that's where we'll leave it. You've seen the hidden blueprint now. You've seen the engineered pattern that plays out day after day. So the final question is a pretty simple one. Now that you see it, are you going to keep being the bait, or are you going to start thinking like the hunter?